There are moments in financial history when entire systems fail suddenly, not because of a single decision, not due to one clear mistake, but because something inside the system had been unstable for a long time, quietly building pressure. In the early 2000s, Iceland was a small country with a modest economy. Fishing, energy, and a steady financial system defined its growth for decades. Then something changed. Its banks began to grow well beyond the size of the country itself. They borrowed heavily from foreign markets, they acquired assets throughout Europe, and they expanded at a pace that few fully grasped. Within a few years, Iceland's banking system became enormous. At its peak, the combined assets of its major banks were several times larger than the country's entire economy. On the surface, everything looked strong. Credit was flowing, investments were rising, confidence was high. But beneath that stability, the system became dangerously fragile. Much of the growth relied on short-term foreign funding. Banks needed constant access to global credit markets just to maintain their positions. As long as liquidity remained available, the system held together. But if that flow stopped, everything would start to break. And in 2008, it did. As the global financial crisis spread, credit markets around the world began to freeze. Lenders became careful, liquidity started to vanish. For Iceland's banks, that change was critical. They were not just large, they were dependent. When foreign funding slowed, they could no longer refinance their debts. Positions that once seemed stable became impossible to sustain. The first cracks appeared quietly. Then suddenly, they didn't. Within days, the system began to collapse. Glitnir was among the first to fail. Soon after, Landsbanki followed. Then came Kaupthing. Three of the country's largest financial institutions fell, one after another. The government tried to step in, but the size of the problem was too great. These banks were not just big, they were bigger than the economy meant to support them. Within days, Iceland's entire banking system collapsed. The national currency lost significant value, financial markets froze, access to capital vanished. From the outside, it looked sudden, almost instantaneous. But the collapse hadn't begun that week. It had been brewing for years. There was no single line of code that failed, no hidden switch that turned the system off. Instead, the failure came from something much more complex. A system built on continuous liquidity, interconnected dependencies, and the belief that funding would always be available. When that belief broke, everything else followed. Researchers and economists later described the collapse as a classic case of systemic fragility, not a single point of failure, but a structure where every part depended on the others. When one piece stopped working, the rest didn't adjust, they accelerated. And once that process started, it moved faster than anyone could control. Iceland didn't collapse due to one catastrophic mistake. It collapsed because the system had no room for error, and when pressure finally hit, there was nothing left to absorb it. Today, financial systems are even more complex, more automated, and more interconnected than ever before. This raises a question that is becoming harder to ignore. If a system like that could collapse because of human decisions, what happens when the decisions are no longer human at all?